for our next panel, Where Are Inflation and the Global Interest Going? I call to the stage Tiago Berriel, Chief Strategist of BTG Pactual Asset Management, along with my friend Phillip Gronniger, Portfolio Manager from Janus Henderson, Erik Zubris, Investment Product Specialist from MFS, and Mr. Erik Keller, Portfolio Manager from Robeco. Please, guys, good panel.
So let's start our panel. Thanks, guys, for coming. Let's start with a major topic to the three of you, inflation. So we have seen a lot of inflation in the US last year that led to very aggressive tightening monetary policy. But now we have seen some softening. So is it done? Has the Fed won, and we are now in an unavoidable path of disinflation and getting back to the target, or even below target for next year that some people are projecting? Or there are other risks that markets are not pricing, and the battle will be longer and tougher than people expect? So maybe Erik.
Yeah, thank you for the question. Yeah, it seems that if you sort of look at the consensus, that markets definitely do see that headline inflation is coming down quite significantly. But the fear is still that core inflation is still a bit too sticky. So when you look at rental, service inflation, and I think that equally goes for the US and Europe. I take a bit of a European perspective. And so there the expectation is that it will take a bit longer for core inflation to come down. And so the Fed will need to keep rates higher for longer. I think you can also take a bit of a contrarian view by saying that, well, actually, if you are in a recession, and what we've seen historically is that there's the risk of over-tightening. So the Fed needs to basically break the economy to really get inflation down. Then you can also hold the argument that actually core inflation at some point will also come down. And I think also if you look at inflation expectations, right? So if I see headline inflation coming down, so I have to pay less for my energy bill, for my food, then at some point I will also probably don't have to ask, don't tell this to my boss, but I don't have to ask as high wages as I would do if I do see more higher inflation. So I think if you look at inflation expectations, if you see the risk of over-tightening by central banks, and as a base case we see recession, then you could also argue that actually at some point also core inflation will come down more quickly. But I think the base case still is that it will be a bit more sticky for this year especially, and that we might see central banks being able to lower rates next year, but certainly not this year.
Yeah, I don't know if it's good or bad, but I echo the same
That's bad.
comments. You know, it's the question is inflation, you know, did the Fed, you know, sort of defeat inflation? And the answer is, I guess, no, but progress is made. So yeah, headline inflation is definitely coming down, but core inflation continues to be sticky. So you find yourself in an environment where, you know, the Fed, in terms of them cutting, is kind of premature. You know, if you think about back to the 1970s, and Arthur Burns was the Jerome Powell then, and, you know, inflation was a problem, and they hiked interest rates, and they thought they had inflation contained, and then what'd they do? They cut rates. Well, inflation wasn't contained, and then they just fanned the inflation fire again, and then they had to hike rates again. Powell and the Fed don't want to do that. So in our view, the same comments from Erik is that we believe that the Fed sort of stays, you know, on hold for at least for the remainder of the year, and maybe then starts to cut.
Yeah, echoing similar comments. This morning we heard Fed Chair Jerome Powell say that the inflation fight still has a long way to go. So in the Fed's own words, no, they've not beaten inflation. It's been nice to see headline inflation come down nearly just over 5% from its peak, so it's at 4%. But when we look at core is sitting at 5.3%. We like to look at a 3-month annualized average number, And when we look at that 3-month annualized number, though, the headline is down to 2.2. So we're encouraged by that, though, again, that core number sits still pretty high. It's at 5%. So we're concerned about the sticky inflation, as you heard from Erik. So it's the services, the housing, and the wages that are a bit concerning. And for the Fed, what they're really worried about is inflation expectations becoming embedded higher. So the recent University of Michigan survey on 1-year forward inflation expectations sits at 3.3. And there have been some academic studies that show inflation will trend lower after an exogenous shock. It'll trend to the long-term, not the mean or the average, but the long-term expected average for inflation. So following on what Erik said about not wanting to be Burns, the Fed's really worried about the expectations by consumers and by businesses that inflation is going to remain higher. So they really want to break those expectations before they feel like they've done a good job. So the impact and what does that mean for decision making? We've seen their summary of economic projections show 2 more rate hikes at 25 basis points each. We're in line with that because if you look at last year and even the start of this year, the market expectations have consistently underestimated the Fed's resolve to fight inflation. And if they're telling us 50 basis points more is the likely outcome, that's probably what they're going to do, though they keep falling back to the data-dependent language. Though again, we've got sticky inflation right now. We're encouraged that it's coming down, especially on the good side. That trend will continue. It'll probably be next year, though, before they're cutting rates.
So you two guys agree with Phil's projection that they're going to deliver the SEP hikes this year? So this is a strategy of pause and hike will follow through?
Yeah, I mean, so definitely we think there's more, there will be more rate hikes from the Fed. I think you've seen that, let's say, markets have pushed out expectations of rate cuts this year, so definitely that's not on the cards. So definitely rates will stay a bit higher for longer. But as said, I think also do not underestimate at some point that the tightening of monetary conditions, but also tightening of bank lending standards, is really having a negative impact on the economy. It always comes with a lag, so there is the risk of over-tightening, which also means at some point you will see much more evidence of a slowdown of the economy, which probably will provide some leeway for the Fed, but also the ECB to cut rates next year, but certainly not this year. So we've seen that being pushed out. And so, yeah, indeed, the central banks want to avoid running the risk that they don't do enough. But historically, we've always seen that if you have this amount of tightening, that the risk of a policy error, risk of a recession is quite substantial.
Yeah, I was just going to say that, I mean, July is very much a live meeting. But I also am, everyone's so fixated on rates and direction of that. And I'm just kind of what Erik was just saying, thinking about growth and tightening. You know, we've seen 500 basis points of tightening in 14 months. You know, if you look at the last 5 hiking cycles, I think what it was 290 basis points over a 20-month period. A lot of that hiking hasn't really hit the real economy yet. So we're going to find ourselves in a slowing growth environment. And unfortunately, the Fed is going to make a mistake twice. They made a mistake in terms of being too late to raise rates. And they're, to Erik's point, I think you were alluding to, is they're probably going to be too late to cut rates as well.
Great. So let me address this to Erik Zubris, and then you guys can, of course, comment. But what's the implication of this monetary policy, all these risks that you guys pointed out in the US for Latin America? And do you have any comment? And the overall dollar strength, how do you see that?
This is getting directed to me because I cover emerging markets debt in my role. So I think in past hiking cycles there was a bigger impact, but what have we seen this hiking cycle? Before we would see the Fed hike rates and then emerging market central banks would follow next. In this hiking cycle, what happened? Emerging market central banks in LATAM and Eastern Europe, they've raised rates in 2021, whereas the Fed raised rates for the first time in March of 2022. So you find yourself in an environment where EM central banks are actually paused to cut. You know, inflation is still falling like a feather, not like a rock. So there's still some inflationary pressure, but nonetheless, the Fed, or excuse me, the central banks in emerging markets are poised to cut rates. So I can think of Peru, Chile, Colombia, here in Brazil. You know, there's a lot of expectations that they're going to be cutting rates. Is it going to be aggressive? Probably not, because inflation is still a problem. But nonetheless, you're going to see definitely falling, you know, local rates, which is, I know when I look at our local currency portfolios, they're very much overweight local rates at this time. In terms of the dollar, it's a complicated one, right? The reason why, let's say EMFX hasn't done well over the last, 10 plus years is because we've seen this bull run in the dollar. And if you think about what environments strengthen the dollar, there's a framework that the team looks at called the dollar smile. And it's two corners of the smile. Those are the two corners where the dollar is strong. So first you have a U.S. outgrowing the rest of the world. So think of it as like U.S. economic exceptionalism. I think of 2018. Trump passed all these tax cuts, and we got this big sugar high from U.S. growth. Dollar was strong. Then you have the other side of the corner where the dollar is also strong, risk-off environment. Think of 2008 very simply, right? There's a flocking to safe haven assets. There's a strengthening in the dollar. Well, if you think about in the near term, if all of our expectations of a slowing growth environment happens, what's going to happen to the dollar? The dollar is going to find itself still keeping some of its strength, and that, of course, is going to still lead to some pressure in local assets, local currencies specifically. But, and we'll talk about it a little bit later, but there is going to be a point in time where you get to the bottom of the smile, and that is where the US dollar actually weakens, and this is very supportive for EM currencies. And this is where you have an environment where you either have synchronized global growth or you actually have the rest of the world outgrowing the US.
Oh, great. Let me change a little bit now. It's for the three of you. Maybe Erik Keller could start. But so there's this issue that, well, we see a lot of, we discussed that the tightening process is still underway. There are many risks that you over-tight and then you have to react. And we see that even though all this uncertainty, all this correction that will have to be done, all this work to be done by the Fed, and probably some easing economic activity and some risks of that, risky assets such as equity and corporate bonds are performing really well, at least this year. How do you guys see that? Is that too much of an exuberance? Is that a result of people expecting that there will be some interest rate cuts very soon? Or people are misjudging the risks of a recession? Or is there anything more fundamental in these assets that would push for that? And I would like to hear your views also on corporate bond defaults. We haven't seen too much of that yet, even though we have a substantial change in the costs of this financing. And I'd like to hear, given your scenario for the economy, how should we expect these things to evolve?
Yeah, I think that has been remarkable that, let's say, and I'm not an equity investor, so let's not talk about equities, but on the corporate bond side, that markets also have been pretty resilient following the volatility that we saw in March of this year, more the bank-induced volatility. But I think indeed if the base case is a recession, then yeah, you will see defaults going up. They're still pretty low. And so it is our expectation that you will see it happening. Now, that, let's say, typically you will see that if you look at credit markets, they priced it in much earlier in the process. So we think defaults are a more lagging indicator, but yeah, defaults will go up and they will probably peak in the last quarter of 2024. We do make a distinction between, let's say, high yield and investment grade. So we do think for some of the parts of the higher quality, the investment grade market, we think there's value. We think you get some compensation for recession risk. Defaults are typically low. But on the high yield side, yeah, we do think definitely you need to see more compensation. For example, if you would look at CCC paper, so the lowest quality segment in the high yield market, yeah, over a 5-year period, 50% can default if you look at history. Whereas it's only less than 2% for BBB, so for more higher quality paper. And we don't think that you're really compensated for this. So we do think that markets need to price in much more of this recession default risk. But typically we'll see spreads widening, way before you see the actual defaults peaking. And once we see that happening, and that could happen somewhere in the coming quarters, then we would also be inclined to take a bit more risk on the high yield side. But we think currently that's still too early to do so.
Yeah, from our perspective, with risk assets off to such a great start this year, we do think it's a little over-exuberance. We think the markets we're pulling forward the expectations for the Fed to start cutting rates this year. So we do anticipate a bit more volatility. As I think about the underlying fundamentals, though, and we are of the mindset that we're likely headed into a soft landing, so not a formal recession. But if we did get into recession, it's a short and shallow one. But the underlying fundamentals have held up really well. So we've seen good earnings this year. We did think from the equity standpoint, we came into the year and equities were too cheap. So when we looked at the valuations there, we did find them attractive. You'll get a little, we think, some volatility, especially as the market absorbs a continued aggressive central bank tightening cycle, so a couple more. When we think about the corporate bonds, as Erik said, we think spreads need to go a little wider, though. We don't think we're being compensated properly for taking risk there, whether it's investment grade or high yield. Now, again, underlying fundamentals are still pretty good. And when we think about defaults, though, in the high yield space, they naturally need to go a bit higher. We've had years and years, more than a decade, of exceptionally low interest rates that have allowed companies to refinance at next to nothing, nearly free money, based on the historical levels they used to borrow at. So when we reset the cost of capital so much higher, it's going to be painful for some of those more challenged companies that are a bit more levered. Their interest costs are going to go up when they have to refinance. It's going to lead to some defaults as the economy does slow down, then their cash flows slow down. Eventually, much like Erik said, we'll start to add some risk, though, hopefully at some wider levels on corporate spreads, both investment grade and high yield. Because right now, broadly across our allocations in our fixed portfolios, we're near the lowest level of both investment grade and high yield allocations we've ever had in our strategies. Just feel like they're not reflective of a slowdown. Whereas if I think about some other risk assets in the securitized space, so securitized credit, though, last year started to much better reflect a slowing economy. Spreads were getting cheaper in mortgage-backed securities, CMBS, ABS, CLOs, and CMOs. So we were shifting some of our allocation out of corporates more towards securitized to take advantage of that better relative value, awaiting opportunity in the corporate space.
I'll just make some comments on EMD, hard currency specifically. So I think, believe it or not, the fundamental picture for a lot of countries, clearly there's winners and losers, right? But in terms of the fundamental picture in emerging markets, it's still pretty resilient. I know over the last year, the headlines have been unkind to the space, right? And it's casted a dark shadow. We've seen a lot of headlines in terms of these smaller, very more fragile frontier countries like the Ghana, the Pakistans, the El Salvadors, the Sri Lankas, where, they've created a lot of noise. But actually, when you look at the broader fundamentals of EM, especially just looking at basic balance, which is a composite of your current account and your foreign direct investment, it's still in pretty good position. So that external position is positive, which then makes the EM countries a little more resilient going into that growth slowdown. In terms of valuations, I've said this before a lot in client meetings. People say spreads are at 450 as of last night. When you look at things historically, that's attractive. But actually, when you unpack the number a little bit more, you realize that those smaller, fragile countries have moved so much in the last 12 months that it's actually skewed that number. So when you actually remove those countries from the equation, spreads are actually rich to fair value. So it doesn't mean you abandon your asset class. You still want to have a structural position to hard currency EMD. But in terms of better entry points, you're probably going to see spreads widening, especially as we go into that growth slowdown.
Great. Let's change topics a little bit. This one I'll address to Phil, and then we move around. Let's talk about the U.S. bank and all the problems that we have seen recently. So I think that the first question is, the Fed and the Treasury have done a lot. They seem to have contained a little bit the acuteness of the crisis. But at the same time, we learned that there were ex ante a lot of risk-taking that didn't make much sense or were not really conservative or were not taken into account properly. And that points out that, I think that led to a crisis because people saw some weakness in terms of regulation and exposure in these banks. So my first question is, are we done with that? Are we safe? Is there anything else that regulators might be missing, and there are some hidden risks in the US financial system that we were not fully aware? And that's the first question, not an easy one. And then the second one is, even if this is this acute crisis is no longer there, the fact that this happened will have consequences and will impact credit in a way that will lead to a weaker recovery or a weaker activity and a more potent monetary policy, a larger impact, a better transmission.
Yep. We do think that the regulators did a really good job of ensuring that it became an acute crisis of some banks as opposed to a systemic banking crisis. Unfortunately, what was uncovered is that there were some mismatches, so asset liability mismatches. The banks were investing in safe assets, AAA rated treasuries and mortgages, but as you heard Erik say earlier, the Fed hikes until they break something. They like to say they bend it until they break it, and they broke it. They broke the banks, and they did that because we'd never seen interest rates rise so dramatically off of such a low level that those underlying securities at the banks that were backstopping the deposits, they had lost 15% of their value. So when we had a run on those banks, now the banks made some mistakes. Certainly they should have gone to capital markets to raise money sooner, but they waited. And then when they tried to sell those securities, then they had to go back to the markets, and the markets had a vote of no confidence. Ultimately, regulators had to step in and, if you will, save those depositors. But we think that they did a good job of ensuring that it did not become a systemic banking crisis. The effect that it had, in our view, was it was almost like the Fed did another 75 basis points of tightening. So you're seeing banks tightening their lending standards because of this asset liability mismatch, and out of fear that there could be additional, if you will, runs on the banks or massive deposit withdrawals. Post-2008, the regulations were set up to stress test the banks for about roughly a 10% deposit withdrawal over a 30-day period. But what happened, and particularly with SVB, they had 25% of their deposits withdrawn in 2 days. It was a classic run on the bank. They hadn't been stressed like that. And it was really it started off by a tweet in Silicon Valley, get your money out. Fortunately, we think while there could be potentially some other regional or smaller banks that could run into some issues, the larger the GSIBs, the systemically important banks, we think they're safe from that. And they're actually, maybe unfortunately, they're beneficiaries too, though, of some of those deposit flows. So some people continuing to take money out of the smaller and regionals, making the big banks bigger and stronger within the respective markets.
Yeah, no, sure. Yeah, I mean, it's interesting. So I think we actually been pretty constructive on banks in our fixed income portfolio. So we've been overweight, but we clearly make a distinction between, let's say, the US regional banks and the larger systematic banks, as mentioned, in the US and Europe. So we definitely do see that the larger banks, are well capitalized. If you look at liquidity ratios, with the post-financial crisis regulation, we've seen that has really improved. If you look at capital ratios in Europe, they've gone from 8% to 18%, so they're much more resilient in that respect. We've seen that a lot of these banks have also been able to benefit from the higher interest rate environment. Up until 2 years ago, it was always the complaint that rates were so low, so did not contribute to the profitability of banks. That has really changed. But of course, yeah, with the US regional banks, we think it's a bit different. Less regulated. There are banks that are more exposed to, for example, also commercial real estate. So there we're a bit more cautious. But we actually think that if you look at valuations and fundamental for the larger banks in the US and Europe, it looks much more attractive. And what we did actually is in March, when we had the volatility in Europe, also with the Credit Suisse, we actually added to our positions. We bought some 81 CoCos. As we think the larger banks are pretty solid, and even if you have a recession, they should be able to weather an increase in credit losses. Now, Credit Suisse was a bank in Europe that was well flagged in terms of problems. We think it's different from the issues with the US regional banks. But yeah, there can definitely be more incidents in US regional banks, and there will be more volatility around this. But we think that will actually be a nice opportunity to add. And we've seen that the banks have actually performed well since the depth of the crisis in March, April. So we maintain our conviction, but again, we avoid the regional banks.
So let's move on to the commercial real estate sector. So this sector has grown a lot. There's a lot of debt out there, and there's a lot of concern on the need of refinancing this debt in the future at much higher rates than before. How do you assess this risk? Do you think there's like the potential of big problems in this sector? Do you see this as opportunities? Maybe if you can start.
Sure. We like the CMBS sector. And when we think about commercial real estate and CMBS, commercial mortgage-backed securities, interestingly, the CMBS market was really born out of the S&L crisis in the US in the 80s. It was financing that came out of the banking problems or the S&L problems back then. But really important is, a lot of times the view is, we use the phrase, throwing the baby out with the bathwater. So the commercial real estate market is less than half of it is office. And we look at a bifurcated market within CMBS for opportunity. We call it the haves and the have-nots. The haves is where we see really good opportunity still, where we see structural and secular, if you will, tailwinds with the supply-demand dynamics. And what do I mean by that? We think that there's still good opportunity in CMBS in the industrial space. So think warehouse distribution centers, right? E-commerce, storage. Self-storage is another place that we like. And then in addition, multifamily housing. So those are all opportunities where we see to benefit portfolios within fixed income in CMBS. The have-nots, and they're well documented, the have-nots are the traditional office and retail. Now, retail has largely gone through its rationalization of supply, right? We've shifted a lot of our purchasing habits as consumers to online. Traditional brick and mortar isn't going to go away completely, though. As consumers, we like to touch and feel things. We like to try on clothes, not just simply purchase online. We like to go into stores and do some shopping, not simply sit behind the computer screen. So the retail market, it's still going to be impacted a bit as we still continue to shift a little bit more to e-commerce, but it's largely gone through that rationalization. Whereas the traditional office, we see that as a very bumpy and challenged road. It's just at the start of its oversupply. And we're looking really closely at central business districts and occupancy rates, where in some cases, for example, there's a building in Baltimore, it's an old financial building. It was built in 1973. It was renovated in 2011. It sits 30% unoccupied. It's got low ceilings, old HVAC systems in it, so it still needs to have significant amount of investment to make it really attractive. We don't see how they fill up minus 30% in the occupancy, so they're only 70% occupied. There's eventually going to be some repurposing and reimagining of those traditional office buildings. But with that throwing the baby out with the bathwater, there's still some opportunity there, though. There's some high quality, single asset, single borrower office space that looks really attractive because it's getting cheaper out of fear that all office is bad. There's some last cash flow AAA in the conduit, and conduit is a bunch of, if you will, commercial mortgages put together. where there may be 30% office underlying that, but those are at the cheapest relative level to single A corporates they've been since the global financial crisis. So we're starting to see some potential opportunities for investments there. One other place in that office space, aside from the central business traditional office that we like, are medical life sciences office parks. Those remain fully occupied all through the pandemic. There's not, if you will, that traditional, the new, if you will, hybrid work environment. I use a joke a little bit and say, you don't really want those lab technicians taking their work home with them and doing it at the kitchen table. You want them in their medical office. So we think there's good opportunity there where the lease rates remain very high and occupancy is still near 100%.
Any comment?
Yeah, sure. In all fairness, we've been more focused on the European securitized market. So we've actually been underweight real estate exposure. We think there still needs to be more repricing. And I think if you specifically look at Europe, markets like UK, for example, where you definitely do see the impact, and we have more floating rate mortgages, where you do see the impact of higher rates on the housing market, and also in countries like Sweden. So we definitely do think that we need to see more repricing before we will be inclined to step back in. In general, I think we do see that also there the impact of the higher rate environment will have negative consequences. And I think, you know, when we invest also on the commercial real estate side, we still have a very cautious view. So in that sense, a bit different than the view here. But yeah, we think we need to see a bit more repricing before we would be inclined to step back into to commercial and residential real estate.
Great. Let me address this one to Erik Zubris. So we have seen a performance of Chinese economy a little bit worse than expected, at least on our side here. So we knew there would be the reopening. There was some signals that there will be some supportive policies towards growth, and data disappointed a little bit. And now we are at this point where we are seeing at the margin a little bit more of expansionary policies, and there's a lot of doubt on how deep the policymakers will go to sustain growth and how effective are they going to be these policies. So I'd like to hear a little bit your view on that, and if anyone wants to comment later.
I think the 2 sessions ago, they talked a lot about China, so I'll keep my comments brief just from our perspective. So short answer, yes. China reopening for the global economy and EM, positive, right? Clearly having your economy shut down and sitting in their condos all day is not good for domestic consumption, clearly. But I also think we need to set appropriate expectations in terms of what kind of growth we're going to get. So this is not like 2009 or even 2015, where we saw this big boost in exports in terms of stimulus too in China. It's going to be much more subdued. You're going to see a lot of headlines around stimulus, but it's probably going to have a very little macro impact. It's clearly going to provide a floor in terms of how far the growth falls. So I think the stimulus is put in place to help them hit their targets for this year. But in terms of what we've seen in the past, I think that's like a false expectation. And if you do look at what they're trying to do, they are trying to deleverage their property sector. That has made up, 30% of their growth over the last number of years. And the 3 red line policy they put in place is to deleverage. They want people to look at their house for living, not for speculation. So as a result, you're not going to all of a sudden start to see this robust growth in that economy. And you also have households that still are saving. They still have a little bit of less confidence in the government. You have unemployment for the youth of around 20%, which is pretty significant. And you still have concerns in the property or in the private sector where there's little confidence as well in terms of what the government may do in terms of regulating their space. We saw in the tutorial, what's the training type of education to kind of help people get through school. That industry was basically decimated. And so other private sector is also being concerned about that as well.
Anyone want to comment? No. So let me move to a more, to sum up our panel here, to a more general question is, what are the biggest risks and opportunity in 2023? And how do you see the fixed income performance coming from? Are we going to see spread compressions? We talked about the possibility of interest rate cuts and activity. How do you see the way to operate your scenario? Maybe we could start with Erik Keller.
Yeah, I mean, so again, the biggest risk for us would be the risk of over-tightening by central banks. But I think it's also important to highlight that, and of course, this will be a slightly marketing pitch for fixed income, but that, you know, higher quality fixed income should be able to do well in a recessionary environment. And I think, don't forget that the important source of fixed income total returns is yield. And I think we're really coming out of a, 2 decades of very low yields where you could say, well, fixed income is not that interesting compared to other asset classes. Yeah, I think that has really changed. And so as long as you're able to stay away from the more risky parts of the fixed income markets, we definitely do think it's a very interesting entry point. And yes, spreads can go a bit wider. Interest rates probably will stabilize, can come down at some point if markets are starting to price in this recession and decline in inflation. So we think you will see positive total returns for fixed income this year. And as long as you, again, stay away from the areas of the market that will be impacted by rising defaults. I think we do also think that spreads will move a little bit wider, but at the same time you have already a very attractive yield and probably risk-free rates will come down at some point, and that will support total return generation. So we definitely do think it's not a bad environment for fixed income, I would say.
I'll echo the biggest risks. I mean, it's clearly Fed in terms of their next steps, and I also echo the opportunity in fixed income. If you think about just the yield environment we were in 2021, and think what we are in today, there's restored value in fixed income again. I make the joke that there's income back in fixed income. So clearly, it's an opportunity for all of us to sort of reconsider how we were allocating capital in fixed income back in 2021. Compared to where we are today. Maybe you don't have to take on the same level of risk. You get the yield, but also you get some preservation of capital as well, because higher quality assets give you a lot more compensation in terms of yield. I'll leave you with this, because this is something that is unique for me in terms of my role. So I've been working with the emerging market debt team for over 10 years, and this is the most constructive and bullish I've heard them on emerging market debt local currency. And why is that? Well, if you think about emerging market debt local currency, it's a very cyclical asset class. And there are 4 stages of that cycle. Right now, we're probably in the 3rd, but in that 4th stage is where you see emerging market debt, local assets really do well. And the reason for is the 2 engines that drive returns are local rates, which are expected to fall, and appreciation in EM currencies. So kind of going back to my comments around the dollar, probably near term, there's still going to be dollar strength, volatility in EM currencies, but once we get past that rough patch and whatever soft landing, hard landing, whatever that recessionary-like environment looks like, EM currencies are going to appreciate given the weakness in the dollar.
Sounding like a broken record, the biggest risk is over-tightening by the Fed. The Fed has a history of making mistakes. If you look at prior recessions, they always over-tighten, they break something. We saw them break something already this spring, yet they're still going. They're still talking tough. They went from raising rates, they've stepped down, and instead of having a dovish communication after the last meeting, it was really hawkish. A lot of people thought this was the pause and then a shift into a pivot of rate cuts, but now it's just a skip. We're going to skip, and then we're going to start hiking again. So that's one of our biggest fears, because the lag effects of all of the tightening last year, 10 rate hikes, they still haven't impacted the economy. That lag effect academically is, they say, roughly 9 months. So we're just starting to feel the effects of their mid-year hikes, mid and third quarter hikes from last year. And things are getting slower. We're starting to see that slow down. But as I think about fixed income, though, and return opportunities, I started back in 1998. Rates were a lot higher. And then we went through the GFC, and we all saw rates go to nothing. And it led to investors having to stretch for yield. And there's a phrase we used to say that if you want yield in a bad way, you're going to get it in a bad way. You have to start reaching for that yield to maintain a certain income level, and that can lead to really bad outcomes. But the great thing today, as I get excited about fixed income, and it's usually not an exciting asset class, is with the reset we painfully went through last year and higher rates, the opportunity set in fixed looks great, and you don't have to stretch for yield today to get that income. And most importantly, too, thinking about how fixed income fits in a diversified portfolio for investors, for clients, it's adding that diversification benefit back as well. We didn't get that last year. Rates went up and it drove risk asset prices down. Oftentimes we get that sell-off in risk assets, we get the benefit of fixed income, and we've reset that equation, if you will, going forward. We think we will get the benefit in fixed income if we get pockets of volatility in equities or in corporate credit. So we think that high quality fixed income in particular is really attractive for a diversified client's portfolio today. And back to what you heard, we're getting income from fixed income again, and it's pretty exciting.
Great. It was a very good conversation. Thanks very much. Thank you, guys.